Howdy, folks. It's finally started. The everything crash has commenced, whether it's commodities, stocks, crypto, real estate, all of it's getting slaughtered. And we're going to be talking about that in this video as the inflation data is coming out July 13th. We're going to be talking about some future predictions coming out of the likes of Michael Burry from The Big Short. Some of your Q&As that you drop in that comment section, I'll be answering in this video as well, taking a look at some individual stocks and my strategy. Now, if that's a conversation you can appreciate, simply hit that like button, folks, because to my surprise and to many people's surprise, with the Michael Saylors and the Peter Shivs of the world constantly butting head, it don't matter if you're in crypto, precious metals, none of them have proven to be an inflation hedge in this time period. In the last quarter, gold has dropped from $2,000 an ounce to the $1,700 range. We're starting to see 20-30% corrections in gold. Silver, guys, the only thing that I would still like to buy that is dipping, that's very hard to get your hands on, is palladium. Even though it's down pretty dramatically in the last quarter, the long chart on palladium, because of the use cases in vehicles, still has given it a much better performance than many other of the precious metals out there. But this is a good sign. This is muy bien, because this means inflation has likely peaked. Right now, we've got gasoline crashing here, guys. Let's take a look at the crude oil chart. All of this is starting to fall off a cliff, and that's just the oil market. I mean, look at copper. It looks like a penny stock that's fallen off a cliff. Wheat, another very prudent part of the entire inflationary market, especially globally on the food supply, has fallen off a freaking cliff. Coal still holding up quite a little bit, to my surprise, as a lot of people have been shifting to coal, probably, causing more carbon emitting problems because fuel has just gotten so expensive. But nonetheless, iron ore, all these lumber materials, building materials, have generally just crashed miserably. So this is by definition an everything crash. And I'm going to be very fixated coming up July 13th to see what this is going to say for inflation. Personally, we've probably seen the tail end of inflation. It's probably sometime mid last month. So we'll see what the data actually comes out to being. But this is the true tail end of seeing these really hyper high inflation prices, or these percentage rates going through the moon, because we all know most of the inflation data has been driven by energy commodities, gasoline, fuel, and energy services seeing the biggest spikes this year. So now that that's finally under control, guys, this means that potentially, probably coming up in the next couple quarters, we'll see kind of the big interest rate hikes, and then those will probably start leveling off. And if the jobs market gets hit because the liquidity's dried up, inevitably, I would think the Federal Reserve, the Canadian Treasury, will at some point become accommodative and either halt the raising of interest rates or start to peter them off as the market inflation cools. Now, kind of taking a look at my own personal credit here, guys, a lot of people have been talking about this. My line of credit, many of you know there's risk with lines of credit. People use it to buy vehicles, make big purchases, but it's very stupid in this kind of a market because interest rates go up every month on line of credits because they're floating interest rates, right? So my line of credit from like 6 months ago, where I had like a 3.5-4% area interest rate, is now at 6.65%, which you can see here on June 2nd, 2022, the Scotiabank prime rate increased by 0.5%, which is pretty staggering. And it's likely this is going to continue to go higher, at least in the near term, right? Now, how is this affecting the general markets? Well, obviously, I'd like to say we found a bottom because the S&P is leveling off, actually trading up about 5% from its recent lows. Let's take a look at the NASDAQ here. Has been bouncing off its recent lows, but again, you kind of can't trust this. This could still be some kind of bear market rally. Nobody knows where the bottom is at. The TSX S&P 60 here, guys, still continuing to find some lows, probably because, again, heavily commodity. Canadian economy is heavily reliant on commodities, gold, oil, a lot of commodities at play in the S&P TSX 60. So it's no surprise that this is still kind of heading lower, but still outperforming the S&P 500. So we'll see how that kind of tames out. So the great Michael Burry has been making predictions on, he thinks the market's going to go lower here. I am arguably stating from, showing you guys John Bogle the other day, stating nobody knows how low the market goes, but he makes a good point I want to touch on, which is adjusted for inflation, these insane inflation rates. 2022 first half, S&P 500 down 25-26%, and the NASDAQ down 34-35%, with Bitcoin down 64-65%. And that was a multiples compression, because the premiums on these companies were trading so high. So we're starting to see some leverage unwind. But next up is the earnings compression. So maybe halfway there. So he thinks we could see the market drop another 10 or 20% from here. But that's because he thinks, obviously, with money drying up, liquidity drying up, I'm seeing it in my advertising business. People have less money to spend, not only on marketing, but that might mean less product sales coming out of Apple, Microsoft, gaming, the broader sectors, right? So if we see in the next quarter, which is very prevalent to pay attention to. So again, we have the inflation data coming out July 13th. And then at the end of July, we're going to get the big tech earnings, which will really show if the economy has slowed down that much, which people like Kevin O'Leary have been debating because he sees in his smaller businesses still a lot of demand. And obviously, if we start seeing a slowdown in multiples or earnings growth, that's going to cause the markets to go down again. But that's not always necessarily true. It's always like, sometimes companies post good earnings and the stocks don't go up. You have to understand that, like I mentioned, lemmings running off a cliff. Everyone and their grandmother wants to make money in this market. The only way to do it is shorting. So you're kind of not really sure about how much the market can drop. How much is baked in from people just buying and holding? How much is baked in from people shorting? What happens if those shorts unwind against perhaps those earnings coming out? Nobody really knows, right? So I love listening to people like Michael Burry, who a broken clock can always be right inevitably, but has been wrong from 2016, saying the markets were going to crash. He's been wrong since he got it right in 2008, basically, and now he's going to get on his high horse and act like he's figured it out. But nonetheless, here, folks, taking a look at the broader market, some of your questions, some of my strategies, at least we get some green in the market today. But again, this green is incremental comparing to, obviously the drops that we've experienced. But again, just another buying opportunity across the board, depending on what you're looking at, which a lot of you have asked me and pointed this out. This says, I'm a fan, Kyle, but I swear your position was contrary to ETFs and other closed-end funds. I guess you changed your strategy. Now, this is a good point because I've talked about this many of times. I am not a genius. I can't, when the markets are going up, a rising tide raises all ships. You can kind of obviously speculate what's going to do well because the earnings growth is so great and the hype is there. It makes the markets a little easier to understand. But you don't want to get caught up being one of those people that ends up picking the worst companies. And I've met these people personally, because let's just say you bought Facebook, which I did. I lost a lot of money on Facebook. That was the first one that slapped me upside the head and made me realize, hey, just because the fundamentals make sense doesn't mean you're going to make money on the stock because it is down 50%. But let's say you picked Facebook, Netflix, Nvidia, PayPal, Amazon, Alibaba. These are all amazing, amazing companies that would have devastated 50% of your net worth. Could you imagine losing 50% of your net worth? And then you have to figure out what ones are the best ones to cost average into. This is the real challenge of the market. And unfortunately, because I am so caught up in my own personal life right now, which you see it in this channel, you see the way I'm posting so sporadically lately. I'm not posting every day like I used to because there's just too much on my personal plate. I don't have the time to micromanage to figure out what's going to perform the best here over the long term when I'm willing to bet on the 500 largest companies with the S&P 500 index. Can you just imagine being able to hire the 500 best CEOs in the US, and if one of them falls out of favor, I don't have to worry about reading the annual reports and they'll just auto-weight themselves out of my holdings? I mean, it's just a lot easier for me in this moment, as again, I want to narrow down my growth vectors so I can really fixate on them. And again, I'm still looking at companies like this, but I'd rather hold the vast majority of my funds in indexes for now, and then hand select and make a very small percentage, maybe 10-15% of my portfolio hand selected companies. Just something to keep me excited, keep me in the markets, right? But you guys got to understand, man, things change dramatically, and sometimes the best thing to do is just walk away, but you cannot exit the market. To walk away with cash, oh man, that would be an even bigger mistake in my opinion. So I'd rather stay 100% fully invested and not have to try and figure out exactly what's not going to drop 50 to 80%, and know that at least the companies that will start doing better start upweighting the index and kind of cushion the bottoms and the downside risk. But this is a question I want to pass off to you guys. How far do you think the markets are going to drop? I'd like to think we're closer to a bottom here with inflation peaking and obviously the negativity as soon as that dries up. I don't know how much bad earnings can, it's so hard to judge bad earnings versus the insane negative sentiment. The negativity drives the markets down, and we're not seeing the markets drop because of earnings multiples right now. It's just that a pure fear leverage unwinding. So there's no way to actually know what's going on. So you can really only stick to a cost average investing strategy and just try and peacefully not do anything too stupid during these time periods, right? But anyways, let me know what you guys think. Stay cool, stay awesome, and as always, I look forward to catching you in the next one.